Rupee was trading with a weaker undertone from the beginning of last week, fueled by concerns on Evergrande crisis and awaiting the outcome of the US FOMC meeting with reference to the tapering timeline, and the policy meeting ended on Wednesday last week without specifying any quantum of reduction in asset purchases each month, although the Fed chair indicated that the asset purchases will end by the middle of next year. The short-term forecast of the rupee to maintain in the range between 73.30 to 74.00 still remains valid. Our recommendation to the exporters to sell their medium-term receivables at the spot target level of 73.80 plus proved to be correct at this point of time. Rupee ended the week at 73.69 after registering a low and high of 73.9250 and 73.58 in the period. With the dollar currently trading at 93.14, rupee's rise can be expected to be stalled at 73.30 level. With the steep rise in local stocks in this week and dollar inflows continuing at a robust pace, the weakness in the rupee exchange rate is limited to a test of 73.80 to 74.00 level and not beyond that in the next 2-week period. Most of the market analysts are expecting the rupee to end the current financial year at close to 75.30 level, which is also quite near to the forward exchange rate for end March 2022 maturity. The market expects the rupee's depreciation up to March 2022 may not exceed the prevailing exchange rate for the corresponding maturity. National Asset Reconstruction Company Limited proposes to acquire stressed assets of about 2 lakh crores from banks in phases within extant regulations of RBI. NARCL intends to acquire these stressed assets through infusion of 15% cash and 85% in security receipts. The Union Cabinet has approved central bank guarantee up to rupees 30,600 crore to back security receipts to be issued by NARCL. This is seen by the market as a good reform measure to strengthen the bank's balance sheet and help them to disburse loans to industries for capacity expansion and for investment in core industries on a selective basis to spur the much needed growth in the economy impacted by the COVID-19. Due to moderate weakness in the rupee exchange rate, the forward drifted moderately higher across the maturities. The 3-month and 6-month forward dollar premium ended the week at 3.65% and 3.90% per annum respectively. Exporters are recommended to sell their receivables up to end December maturities, targeting a spot level of 73.80 to increase the export realization. The forward market differential between the 3-month and 12-month maturity has marginally contracted to 0.68% per annum. The paying interest in long-term maturities is much lower as compared with that in short-term maturities. The sovereign bond received support encouraged by easing domestic retail prices. The August CPI inflation was 5.3% and July's 5.59% stayed within the RBI's upper tolerance limit for a second month in a row. The huge rupee liquidity in the banking system and FII flows into debt supported the bond prices and pulled down the bond yields. The 10-year sovereign bond yield ended the week at 6.18% per annum. Foreign banks were seen buying the sovereign bonds while the selling interest is very much limited in the market. Indian Finance Ministry officials plan to pitch for the sovereign rating upgrade from Moody's Investor Services when it meets with the firm scheduled for 28th September. In the event Moody's upgrade the sovereign rating at a later date, more dollar inflows into the bond portfolio and VRR scheme can be expected, which could gradually drive the sovereign bond yields lower. After touching a low of 73.9250 on Wednesday, the lowest level since 27th August 2021, rupee retreated to end the week at 73.69 as the local stocks registered a steep rise on Thursday and Friday. Gradual rise in the rupee to 73.50 level can be expected in the coming week as local stocks zoomed higher, with the BSE Sensex recording a new lifetime high of 60,333 on Friday last week.